Hello, everybody, and welcome to another edition of How Do I Overeducate My Lower Division Accounting Students, aka why is Tchaikovsky bringing in intermediate accounting topics to Accounting 1A honors? It's fun. So this video here is copyright 2025 by the accounting professor. I'm Bennett Tchaikovsky. Any opinions and horrible dad humor, and if a cat comes in, I promise I'm not going to yell at the cat to get out of my shot. But any opinions, horrible dad jokes are all of myself. They all belong to me. They're not part of my employers or any other affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. By the way, if someone does choose to Zoom bomb me, I will go through and embrace them. It's the best thing you can absolutely do. So, God, I'm saying that now. I kind of want my cat to come in. It's going to make much more video, much more exciting. So let's go ahead and take a look at this one. So Zizix sells inventory costing $2,400 to Barstow on January 1st, 2030. BI will pay ZI $2,000 on 12/31/30, 12/31/31, and 12/31/32 via a note. There is no interest rate stated on the note. However, the relevant market rate of interest for notes of a similar type is typically 8%. Assume that BI makes all payments, go through and record the journal entries, and then record the journal entries for BI on these different dates. So when we go through and look at this, the first question you kind of want to go through and ask yourself, and I mentioned this on the other videos, which are what are the 5 steps for revenue recognition? And when we look at these, basically the 5 steps is we're going to identify the contract with the customer, identify the performance obligations, determine the transaction price. We're going to allocate that transaction price to the performance obligations. And then lastly, we're going to go through and recognize that revenue. Typically, what I usually will do in my lower division accounting classes, I'll say, well, have we done all the work we need to do in order to recognize the revenue? Although that is not technically correct for lower division accounting students, that's usually the way I like to kind of go through and describe it. But when we have this over here, you have to remember that under GAAP, if we see payments coming in the future, $1 today is not the same as $1 tomorrow, because theoretically, right? If I have year 1, year 2, and year 3, okay, so if I have year 1, I'm going to get $2,000 in each of these years. Well, if I had $2,000 today and I could invest that at 8%, that would be worth $2,160. If I had $2,000 that I would be getting 2 years from now, that would be worth $2,332. If I had $2,000 that I can invest today and get that, 3 years from now at 8%, that money is going to grow. So when you see a problem where there's no interest rate or 0 interest, you're going to have to impute interest, meaning that we're going to have to figure out, well, what should that interest rate really go through and be? So when we have a question like this, we've got Zizix selling inventory costing $2,400 to Barstow. So first thing immediately is, well, if we're selling inventory, right, what do we need to go through and do? Well, when we go through and sell inventory, we've got our assets are equal to our liabilities plus our owner's equity. We've got expenses, we've got revenues, we've got debits, and we've got credits. Why is this so important to know, right? So assets typically have debit balances. They're increased with debits and decreased by credits. Liabilities and equity typically have credit balances increased with credits, decreased with debits. We record revenues with credits, expenses with debits. So when I go through and sell inventory, there's 2 things that are happening on 1/1/30, right? I would typically be doing notes receivable, crediting sales, and then over here, I would be debiting cost of goods sold and crediting inventory. Okay, so this is typically what I would be going through and doing. And I would do this saying, well, I'm getting paid $2,000 3 times. So this is going to be $6,000 because it's 2,000 a year for 3 years. I'll go ahead and just record sales. And then my cost of goods sold and my inventory are accordingly right over here. However, I know that this is a farce because if I watch the last video, I know, wait a second, you can't record this at $6,000 because it's not really $6,000 of sales, because part of this is really hidden interest or interest revenue. So coming over here, what I'm going to need to go through and do is I need to impute interest. The way I'm going to go through and do that is I can really do it one of two ways. Is I could say, well, you've got over here at 12/31/30, 12/31/31, and then we've got 12/31/32. I know I'm getting these payments here, right? So I could do present value of $1, 1 period at 8%. I would use that factor here. I could do present value of $1, 2 periods at 8%. I would put that factor here. I could also do present value of $1, 3 periods at 8%, and I would put that factor over here. So when I go through and I basically go through and do this stuff, I could use that. However, instead of getting 3 separate numbers, let's just go ahead and do this for fun anyways, because we're always having fun here in accounting. So if I did this with my lump sum table, present value of $1, I go 8%. This is 0.92593, 0.85734, 0.79383. Perfect. Okay. So if I multiply these through, I would come up with a total value of 51,5420. But I'm lazy, right? Well, it's not that I'm lazy. I don't want to do that many computations. Okay, so what I'm going to do instead is if I take one of the payments, and again, this is for an annuity. An annuity means it is the exact same amount every single year. So I'm going to go over here, present value of an ordinary annuity of $1. I'm going to do the number of payments, or 3 payments at 8%. Okay, so I'm going to come over here. 3 periods at 8% is 2.57710. If I multiply this 2,000 by 2.57710, magically I get the same number. How exciting. Okay. So when I'm going through and recording this, similar to what we went through and did previously, I'm basically going to say, well, my sales is going to be recorded at that present valued amount. And the difference here is going to basically be my discount on notes receivable. Or here, this is going to be 846. What does this represent? Well, this really represents interest revenue. And so what I'm going to need to go through and do is to basically go through and record this every single year. Now, this also brings up a really interesting point here. If I was doing a balance sheet as of right over here, we'll just call this as of 1/1/30, and then we'll go ahead and do this for the different periods, 12/31/30, 12/31/31, and then 12/31/32. Is this, I was going through and doing my balance sheets, something interesting is happening here. Well, what's so interesting? Interesting. So I have current assets and then I have non-current assets, right? And what's interesting about this is as of this date, well, part of this 6,000 is going to be due in the coming year to me, or 2,000 is going to be due within like the next 12 months. But there's basically going to be 4,000 in terms of my notes. Which will be non-current. Okay, so it's important for us to kind of go through and look at that. I'm not going to test you on this because I would have to go through and split up the amount of the discount, which I don't want to do at this point because I'm kind of like, I don't want to say I'm lazy, but what I'm just going to go ahead and do for our purposes is I'm just going to call this all non-current until the very last year. So if you're taking my class and you got a question like this, we'll just go ahead and assume that it's non-current, even though it's not technically correct. Okay, so over here, my notes receivable net is going to be at 51.54. Now, for this question, what I want us to do is something a little bit different. Because when we go through and look at this, right, it's asking us to go through and record the journal entries. This is the correct initial entry, but I'm going to need to go through and record journal entries on 12/31/30, 12/31/31, and 12/31/32. Unlike the last problem that we went through and did, right, on 12/31/30, 12/31/31, and then 12/31/32, there are actually this time, there are going to be two things that are happening. One is I'm going to be recording interest revenue, but at the same time, I'm also going to be recording the receipt of cash. So every single time, right? So at the end of every period, I'm debiting cash, crediting notes receivable. Debiting cash, crediting notes receivable. Debiting cash, crediting notes receivable, because this is what was going through and being paid to me during this period of time. But at the same time, what I'm going to also need to do is remember, what is this discount on notes receivable? This is just really another way of saying interest revenue. So when I come over here, my journal entry, when I go through and handle this for, I'm going to have a discount on notes receivable. This has an opening balance on 1/1/30 of 846. What I'm going to go through and do is that every single time I'm going to go and recognize interest revenue, basically for this particular note. So over here on 12/31/30, I'm going to need to go through and recognize interest revenue. So at the same time of recording the cash and the notes receivable, I know that I'm also going to have to go through and debit discount on notes receivable. And I'm also going to have to go through and credit interest revenue. So that's also something I'm going to need to go through and do as I'm doing these questions. Okay, so first thing I need to do is I need to figure out what is my notes carrying value, right? What is the carrying value of my notes? Well, as of 12/31/30, and let's find a good way to put this someplace here. So as of 12/31/30, CV, and my notes receivable net had a balance of 51.54. My relevant rate of interest, what I would use to go through and discount the note at. So my interest revenue is going to be right over here at 412. So when I go through and record interest revenue, right? I'm going to record this over here with a credit, and then I'm going to discount, or basically I'm going to debit my discount on notes receivable for the same amount. So remember, when I go through and I'm basically determining over here, what is my notes receivable net? Well, I got to figure out what is my carrying value of my note. When I initially went through and reported this, I had over here notes receivable, that carrying value was 6,000, right? So over here, initially my carrying value was 5154, or what I recorded the sale for. I take that, I multiply it by the interest rate, I get interest revenue of 412. So I'm going to go over here and basically record this discount on notes receivable at 412. I'm going to record interest revenue at 412. So at the end of the accounting period, right, my discount on notes receivable as of 12/31/30 is now at 433. Remember, interest revenue, like all revenues, expenses, and dividends, will be closed out to retained earnings, right? So that's going to get closed out to retained earnings. Just give ourselves a little bit more room, and let's go and continue to have some fun. Okay. All right. So the next thing now over here, so this is 12/31/30. Now, this is what we have to kind of go through and do, is to be mindful of this. When I have this payment, right, coming over here, when I received the cash, right, my notes receivable initially had a balance of 6,000. So I'm going to put this on the wrong side. My notes receivable initially had a balance of 6,000 on 1/1/30. Right. However, I got paid $2,000. So my balance as of 12/31/30 is going to be $4,000, right? Because that's how much they owe me after that payment has been made. So now over here, my notes receivable is now going to be $4,000. My discount on notes receivable is going to be over here at 433. So my notes receivable net is going to be 3567. Okay, so that's basically what's going on with my notes receivable. Okay, so let's go through and do the next year. Okay, so my notes receivable carrying value on 12/31/31 is going to be my carrying value from the prior year. Remember, this 6,000 is dropping by 2,000 every year because we're going through and getting these cash payments. It's an installment. So coming over here, my notes receivable net is going to be at 3567. My relevant rate of interest never changes, is going to be at 0.08. So this is going to be at 285. Now, if you're looking at this and you say, well, wait a second, the interest over here on all these interests, on this prior problem I was doing, when I had the interest revenue was always going up. Why is this going down? It's because the principal is reducing the amount that's owed to me every year. Therefore, the interest revenue will drop. So that's why this part of it here is important to do. So the amount of interest revenue I'm going to record is going to be 285. So for 12/31/31, I'm going to record 285. My discount on notes receivable had an opening credit balance on 1/1/31 of 433. I'm recording interest revenue of 285. So my ending balance and my discount on notes receivable will now be at 148. So what do I go through and do? Well, I've already recorded the cash payment. So now I'm going to go ahead and record my discount amortization to interest revenue. So this would be 285 and 285. Okay. So let's go through and take a look at this. So now after this payment was made on the note receivable, So on 12/31/31, so this is my 12/30 payment. I got another payment over here of 12/31 payment. So my balance as of 12/31/31 is basically going to be at $2,000 right now. This at this point over here, we would probably be going through and showing this over here as going to be a current asset, because this amount is going to basically be due in the coming year. So we'll go ahead and show this as being a current asset. So my notes receivable less my discount amount is going to be right over here at 148. This is post amortization of the interest revenue. So my notes receivable net is going to be at 1852. Okay, so last one right over here is my discount on notes receivable had an opening balance on 132 of 148. I now need to figure out what was my carrying value at the beginning after I made that payment on 12/31/31. My notes receivable net had a carrying value of 1852. Multiply that by 0.08, I'm going to come up with 148. So coming over here, my interest revenue as of 12/31/32 is going to be at 148. So I've gone through over here and I have fully amortized this discount on notes receivable. So the last step I'm going to do over here is basically debit the discount on notes receivable for 148, credit the interest revenue for 148, and I would also need a payment. So this is what I would be going through and doing. Okay, so some thoughts over here again. Okay, so when we look at these payments, right, again, $1 today is not the same as $1 tomorrow. If you see something that says zero interest, it's not. You have to go through and impute interest. We need to know what is the relevant market rate of interest. When we go ahead and look at this, and there might also be like a different rate. I'll have to make another video on that soon, but I'm trying to simplify this at least a little bit. So when it comes through, the difference between this and the prior question was that this is going to be what we call an annuity, right? Because it's being paid over equal streams. If it's being paid over equal streams, instead of doing these tedious calculations, I can just go to the present value of an ordinary annuity of $1, multiply this through here, and I'm coming up with this value. Okay. So when I go through and record the sale of inventory, right, the note receivable will always be shown as the gross amount. I will need a discount for the amount of the imputed interest. In this case over here, it's the difference between the present valued amount and then my total note receivable of $6,000 or 846. Cost of goods sold, inventory, exactly the same. Now, when I did this question, I did it a little bit differently. Because there's the cash payments coming out every single year, I went through and I took care of those payments. Then the next question becomes is, how do you go through and then record the discount on the note receivable? So coming over here to my discount on the note receivable is I'm taking that note receivable net, multiplying it by the interest rate or the carrying value of it, which initially was right over here at 51.54. So I went through, took that initial amount of my interest or my initial carrying value, multiplied it by 8, that 51.54 by 8%, came up with interest revenue of 412. How do I go through and record the revenue? Record revenues with a credit. I'm going to amortize that discount on notes receivable at 412, giving me an ending balance over here of 433. Now, what you have to realize, though, is that every time we're making a payment, the note receivable amount is dropping, right? This is no longer 6,000, it's 6,000 minus the $2,000. So if this is 4,000, with this discount amount over here of 433. So again, did the same thing. What is my carrying value? It's the notes receivable less the discount. Over here, it's 3567. I multiply that by the interest rate, get my amount of interest revenue, right? How do I record revenue? Record debit credit. I'm going to be debiting my discount on notes receivable. So I come over here this last year, and by the way, theoretically, I should have been having like $2,000 up here, and then this would have been 4. This would have been 2, and this would have been this one would have been 0. But again, I made this a little bit more simple for myself, but technically that's something we would have to go through and do. Although on a 2-hour exam for a lower division financial accounting class that I'm making near next to impossible, there you go. Actually, not that. You guys, you're going to do fine. So coming right over here last year is that I'm doing the same thing again. The carrying value of my note, because of this payment here, is now at $2,000. My discount prior to the payment going through. So this is my right over here, 148, which is magically makes this discount go down to 0. So if I were to go through and do this now from the opposite side, right? So let's now go through and solve this for the other side of this one. And again, I love my videos because I violate absolutely every single rule on YouTube, which is I make them way too long, but that's okay. If I'm doing this for BI, so for BI, what we're looking at doing so if I'm doing this for BI, right, BI is going to have to make payments of $2,000 for 3 years. But what they're doing here is they're essentially saying, well, normally when I purchase inventory, I would debit inventory and I would credit notes payable. When BI is recording notes payable, you always do so at the gross amount. However, we know that for BI, that $2,000 every single year is not the same thing as having to pay out $6,000 today. So the amount that I'm going to record the inventory at is not going to be at the 6,000, rather it's going to be at the discounted amount or the 5154. Now, so my total debits equal my total credits. Over here, I'm going to basically be debiting discount on notes payable. And this is really my holding account for interest expense. So that's what we're doing over here. Now, for BI on my balance sheet, I have current liabilities and I have non-current liabilities, okay? Technically, what I would need to do is I would need to bifurcate my notes payable. What do I mean by that? I would need to split them up between current and non-current. So as of 1/1/30, when this problem originally started, I'm opting just to say here, okay, we're going to basically be saying here like $6,000, but technically I would probably have to do this between 2 and 6. I'm just putting it here for our purposes of $6,000. So I'm going to have less discount on notes payable. Okay, so right over here, my discounts on notes payable, and this is going to be my notes payable net. Okay, so 12/31/30, 12/31/31, and then 12/31/32. Similar to what we did earlier, we know that every single year, right? So 12/31/30, 12/31/31, and then we've got 12/31/32. We're going to have to make cash payments, and we're going to have to be debiting notes payable. Remember, it's going to be, if we're doing this from BI's perspective, I have to pay $2,000 every single year. So every year, I'm going to be debiting notes payable, and I'm going to be crediting cash. Now, we also know that when you have something that is zero interest, it's not real. So what I'm going to need to go through and do is to record interest expense. And what I'm going to be crediting here is going to be my discount on notes payable. And what my goal is to do with these discounts on notes payable, and you've seen this too with bonds, is my goal is I want to make this discount on notes payable of 846. I want to make this ultimately go to zero. So how am I going to do that? I'm going to need to credit this while at the same time, I'm going to be debiting interest expense. So let's go through and take a look at this for our problem over here. So we're debiting interest expense, and we're going to be crediting our discount on notes payable. Okay, so my discount on notes payable at a beginning balance of 846. So let's go through and do the computation of interest expense for 12/31/30. So my carrying value for as of 12/31/30 prior to any type of adjustments, my notes payable net as of the beginning of the year was 51.54. I multiply this by my interest rate. Always use the same rate that you're going through and discounting this, using this hereby. There are special rules for going through and using interest rates. I'm choosing just to choose one. So over here, my interest rate. So my interest expense for the first year over here is going to be at 412. Okay, so I'm debiting interest expense for 412 on 12/31/30. I'm going to credit my discount on notes payable by that 412. The ending carrying value, or the ending value of my discount on notes payable, is going to be at 433. So here I recorded interest expense of 412, crediting my discount on notes payable over here. And I've done this first part. Now, when I look over here at my balance sheet, my note payable, because I went through and paid this down, right? I debited cash, so I credited cash, debited notes payable. This is now gone down to $4 grand. Remember, technically to do this correctly, I would need to put 2 and 2. I'm just splitting it up like this over here. So, I'm choosing not to split it up for purposes of doing this question. So over here for my discount on notes payable, this now had a balance of 433. So my carrying value of my notes prior to the payment on 12/31/31 is 35.67. So to do the carrying value on 12/31/31, my notes payable net was 35.67. My interest rate hasn't changed. Now my interest expense is going to be at 285. So let's pull down these T accounts, and we'll do this one more time. Okay, so okay, so 12/31/31, my interest expense is going to be at 285. My discount on notes payable on 1/1/31 had an opening balance of 433. So the ending balance on my discount on notes payable is going to be at 148. Remember, expenses, revenues, and dividends all get closed out to retained earnings. So I'm now going to come over here and record my interest expense for the year of 285. And my description is to record cash pay or payment, or record note payment and interest expense. So have this over here and ready now to go to my last time period. So what I'm going to do now is I'm actually going to go ahead and move this up So over here on 12/31/31, after I made that payment, this is going to be at 2,000. My amount of my unamortized discount is going to be at 148. So at 12/31/31, it's at 148. So my notes payable net is going to be at 1852. Remember, what does a current liability mean? It means that I have to pay it within the coming year, right? So just remember, I'm just doing this for simplicity's sake. I would have to bifurcate it, which means I would have to go and probably use this table here to basically figure out the amount I should really be going through and doing the split with. Okay, so now last part over here, basically at 12/31/32. So my opening balance on 1/1/32 is going to be at 148. So over here, how much interest expense do I go through and record? Well, my carrying value of the note. Got this here at 0.08. So my interest expense is at 148. So for this very last year, I'm going to be debiting the interest expense for 148. My discount on notes payable, yay, I've done this correctly. It's gone down to 0. So over here, my very last entry base for this is going to be 148 and then 148. So I've heard from when I go through and teach, I'm oftentimes talking with my former students. And when I talk with my former students, I'm oftentimes asking them, what did I do right? What could I have done better on? How do I improve my teaching? And I've had an overwhelming, and what I just showed you right now is all with using the effective interest method. And what I've had happen is like an overwhelming number of my students have said, hey, you've got to show the present value. You've got to show the effective interest method because that comes up huge on the CPA exam. Hence why I'm going through and teaching it to you. Like with all accounting, and when I spoke with Jeff Elliott at Ninja CPA Review, he reinforced kind of to me the importance of handwriting out these solutions. If you're watching this video and you're using Wiley Plus or McGraw-Hill or Spiceland or whatever that stuff is, and your instructor is having you, use some kind of electronic portal, really try to write it out for yourself because there's really no other way you can really learn this unless you actually put the pencil to paper and, learn that accounting. So in any event, thank you for being with me here today. I look forward to seeing you on the next accounting video. And to all my accounting 1A students, I'm probably not going to find a way. I probably need to bring over some more treats for the next exam. Have a great rest of your day. And my cat is not in my shot. I'm really sad about that. Have a great day.